Hey, it's Stuart. I want to take this opportunity to share a tip with you. And really, it's about when we go and invest in property and we borrow to invest, should we set up that investment loan with interest only repayments or principal and interest repayments? Now, typically, historically, I've always recommended interest only repayments because there's two real benefits of that. Firstly, it minimizes the amount of cash that you need to contribute towards a property's holding costs. And that frees up more cash for other things like repaying non tax deductible debt, your home loan, contributing to super, making other investments, all those sorts of things. Secondly, it preserves the original tax deductible nature of the debt. If you want to make notional repayments, you can always put money in a linked offset account. But the important thing with an interest only loan is the original principle of the loan remains intact. And that's great from a planning perspective, because from a tax rule perspective, once you repay an investment loan, you can't get it back again. You've either got to change the ownership of that investment, which is typically not wise to do because of capital gains tax and if it's property stamp duty and these sorts of things. So you have to think very carefully about repaying a loan. Now, the challenge is, however, most lenders charge a higher interest rate for an interest-only loan compared to a principal interest loan. And if you have a look at the standard variable rates of all the banks, there's about 0.25% difference. In fact, to be exact, 0.26%. So if you're going to repay interest only, you're going to pay probably a higher interest rate. One thing that you could consider doing is repaying principal interest, but resetting the loan term every, say, 3 to 5 years. I worked out that if you had $1 million loan, you paid principal and interest, and every 5 years you reset the loan term back up to 30 years ago, that you would only repay about $20,000 of principal over that 20-year period, which is not much, right? It's not that material. So that could be a good way of saying, yes, I will pay principal interest, but to minimize the amount I'm repaying against the loan, I'll reset the loan term. Because in the first few years of a loan term, most of your repayment is interest. You don't actually repay much principal. And that's kind of the benefit. Now, of course, it's not going to suit everyone. If you have a non-tax deductible loan, you probably should be interest only on investment so you can repay the home loan faster. If your cash flow is tight, it's probably not going to suit you. But if you are in a situation where you have the cash flow and the cash flow differential shouldn't be too much, then to minimize your interest costs, setting up the loan as principal interest might be a good way to go. I'll include a link to a very short blog I wrote about this, which gives you a bit more detail in writing if you want to check it out. But I thought I just want to share that tip and hopefully it makes sense. Cheers.